The book Wealth Within, available on Amazon, explains that the human psyche isn't a cold, calculating machine when it comes to finances. It's a swirling vortex of emotions, biases, and deeply ingrained psychological tendencies that often influence our decisions more than rational analysis. Scenario B offers a 50% chance of losing $100 and a 50% chance of losing nothing. The fear of losing money often outweighs the excitement of earning profits, leading to overly cautious strategies or even a risk-averse approach. This can show up in various ways. For example, investors might hold on to losing investments too long, hoping for a recovery instead of cutting their losses and reinvesting elsewhere. The fear of losing can cause inaction, missed opportunities, and poorer financial outcomes. It's about more than monetary loss. It's about the emotional cost. One helpful approach is to frame decisions in terms of opportunity costs rather than potential losses. Instead of focusing on what you might lose, think about what you could gain from an investment. Changing your perspective in this way can reduce the emotional burden of potential losses. Feelings of regret, self-blame, and damage to self-esteem can outweigh the actual financial loss. And base decisions on a long-term perspective rather than emotional reactions to short-term changes. Initially, she was overly cautious, driven by her dislike of loss. She chose low-risk investments, sacrificing potential gains to avoid even the slightest chance of incurring a loss. Over time, however, she learned about diversification and the importance of a long-term strategy. She gradually shifted her focus from minimizing loss to maximizing long-term returns. This shift involved consciously managing her emotional response to market changes, recognizing that fluctuations are a natural part of investing. This is known as the disposition effect, the tendency to sell winning investments too soon and hold on to losing ones for too long. When many investors react to losses simultaneously, a domino effect can occur, creating a self-fulfilling cycle. It's about adopting a rational, calculated approach to investing, grounded in a clear understanding of market dynamics and human psychology. By recognizing and managing loss aversion, you can make more informed choices, lessen emotional stress, and build a more sustainable financial future. Achieving this requires knowledge, self-awareness, and dedication to long-term planning. It's a journey of self-discovery, paving the way to financial well-being through understanding, discipline, and emotional resilience. By understanding the psychological biases that influence her decisions, she learned to make more rational and informed choices. Loss aversion is a powerful force, but with understanding and practical strategies to mitigate its impact, you can navigate the financial world with greater confidence and resilience. This way, you can create a future that aligns with your values and goals. It involves continuous learning, adaptation, and embracing the complexities of both the financial landscape and the human mind. It's a journey of growth that leads to a safer, more fulfilling financial life. And ultimately, it's the journey itself, the learning, self-reflection, and steady progress that truly builds financial wealth within. This underscores the importance of financial literacy, not just understanding financial products, but also understanding one's psychology and emotions. Logically, both scenarios carry the same risk and potential outcomes. Yet, most people find scenario B far more upsetting. The idea of losing $100 triggers a stronger emotional response than gaining $100, even though the monetary outcome is the same. This is the core of loss aversion. This doesn't eliminate the chance of loss, but it mitigates the impact of a single bad event. That way, the emotional toll of a loss becomes smaller because it's less significant within your overall portfolio. This is especially clear in the realm of loss aversion, a powerful cognitive bias that significantly affects our investment strategies and overall financial well-being. By consistently monitoring your investments, you can identify potential issues early and take corrective steps before they worsen. Focusing on long-term growth rather than short-term gains can help you avoid the emotional roller coaster caused by daily market fluctuations. This approach helps mitigate emotional reactions to short-term volatility, thereby reducing the influence of loss aversion on your decisions. This proactive approach enables you to address possible losses before they become emotionally overwhelming. Loss aversion, in simple terms, describes our tendency to feel the pain of a loss more intensely than the pleasure of an equivalent gain. This isn't just a minor quirk. It's a fundamental part of human psychology that can lead to irrational financial choices. Imagine you represented with two scenarios. Scenario A offers a 50% chance of gaining $100 and a 50% chance of earning nothing. This imbalance in emotional response greatly influences our investment behavior. Take the case of David, an experienced investor with a diversified portfolio. He had consistently made smart decisions over the years, demonstrating a rational and calculated approach to risk. But when the market suddenly dipped, David's emotions took over. He held on to his losing investments, hoping for a quick rebound, ignoring the principles of diversification and risk management. His fear of realizing a loss was more potent than his understanding of market fundamentals. The emotional pain of admitting loss was just too much. This illustrates the significant impact of loss aversion on logical decision-making. Loss aversion also affects broader market behavior. It can cause market volatility, leading to sell-offs and worsening downturns. But understanding loss aversion isn't just about recognizing its negatives, it's about learning how to lessen its impact. Another good strategy is to diversify your investments. By spreading your assets across different types, you reduce your exposure to any single risk. Regularly assessing your investment portfolio can also help manage the emotional impact of loss aversion. Additionally, adopting a long-term investment strategy is essential. Remember, financial markets are naturally volatile. Losses are unavoidable. The goal is not to eliminate loss, but to manage its emotional impact. Let's look at Emily's case, a young professional with a modest investment portfolio. Emily's story demonstrates how education and self-awareness can help reduce loss aversion. Financial success isn't just about building wealth. It is about developing a healthy relationship with money, one that is free from the crippling effects of emotional biases, such as loss aversion. The journey to mastering your finances isn't solely about accumulating wealth. It's about cultivating a mindful, balanced relationship with your money, one that acknowledges and manages the powerful influence of emotions and psychology.